And sure enough, when we got Bitcoin getting bashed the last week or so, what's happening to NVIDIA and Palantir? Suddenly they become weak components of the S&P and the Nasdaq. Watch it. Watch Bitcoin. It's very important. And by the way, when we get there to those levels, oh sure, you get a sharp correction maybe, but you're in a new reality. You're not going 150, 200 and come back to 50, okay? You're going to live in a new reality up there. Maybe it's between 150 and 250, I don't know, but it's the main focus right now is that surge, because it should be very dynamic and a place to be you've probably not been in your entire investment lifetime. So game is on, but we're watching those two metrics, gold S&P, silver gold. We showed this over the last months, and especially back in a September report, we showed an overlay of the S&P 500 back in 1987, when it had been going up and up, and the price chart just looked lovely. Momentum had built a floor spanning a couple years where the price was going up, there was rising lows, but momentum was making the same low over and over and over again, where it was dropping down, the price was dropping down to its rising three-quarter moving average, and therefore the oscillator showed a repeated drop to the zero line, okay, a flat floor, a structure. When it broke it, it crashed. Didn't even wait around for the end of the month close to break it. It broke it intra-month, gone, okay. This is the fourth time that Bitcoin since 2023 has dropped down to its three-quarter average. That number this quarter is 101,390. Okay, we've been trading below and above that for the last few days, so we've come down to that structure again for the fourth time. We don't think it'll hold this time. The question is, do you wait for a close, monthly close below that number? We got a long way to go to the end of November. Or do you maybe assume this time, don't wait, it's not going to hold, just like in 87 for the S&P? That's our assumption.
Bitcoin has returned to its key support zone around $1,390 after several tests of that structure. If monthly closes fall below it, we may see a meaningful breakdown. Analysts project a swift move lower, not necessarily a crash overnight, but a steep slide within weeks. Some scenario maps point toward 30% losses from current levels if the support fails to hold. With Bitcoin's recent high near $127,000, the potential downside looms. That risk matters because Bitcoin is no longer isolated. It ties into broader markets and investor behavior.
Now, does it have to crash? No, I'm not going to argue that. Crash meaning like 30%, a matter of a week or so. But it's a disastrous number regardless. And, it wouldn't shock me that when you break this, that 3 months later or maybe 3 weeks later, you see that the Bitcoin, which, by the way, is highly correlated to the month-by-month price action of Nasdaq 100, is 30% or lower below where we are now, meaning you could be 70,000, 60,000 or something on Bitcoin. Remember, its recent high was 127. It could cut you in half, much of it occurring rapidly. Now, the problem with Bitcoin doing that, aside from proving to the gold doubters that Bitcoin is an alternative to gold, which it is not, but it's linked to the stock market. Its inhale-exhale behavior since 2021 on Bitcoin monthly bar charts versus Nasdaq 100 is practically an overlay. They look like brother and sister. In fact, we ran those charts and removed the name on the chart and the price scale, and you can't tell the difference hardly. So if that Bitcoin breaks our structure, and it's down to it now, if you break it credibly, like a monthly close, or don't even go lower than what you've already done the other day, like 99,000. It's likely to have a wave impact on Nasdaq 100 because the same speculative inhale-exhale fever is going on there.
Bitcoin's relationship with major equity indices is more intertwined than many assume. Historically, its correlation with the Nasdaq 100 has climbed during risk-on episodes, and despite some recent weakening, the link remains top of mind. When Bitcoin weakens, speculative tech components often suffer too. The logic: The same inhale-exhale dynamic of capital flowing into growth markets seems to include crypto. If Bitcoin cracks its base, we may see ripples into equities just as much as into crypto.
And sure enough, when we got Bitcoin getting bashed the last week or so, what's happening to NVIDIA and Palantir? Suddenly, they become weak components of the S&P and the Nasdaq. Watch it. Watch Bitcoin. It's very important. All norms of technical analysis, like RSI and so forth, will be a total falsehood if you follow them. In other words, once you get silver up to a monthly RSI that's overbought, if you get out there, you're going to miss the move. Even back in, I think it was 79, you got monthly RSI above the what is the overbought level, stayed there for like 5 months. In other words, you should have bought the overbought level because it stayed there for 5 minutes, it exploded. In other words, all the norms get smashed. We have a situation in silver where, for some reason, and one reason may be the artificial suppression of the market by certain banks, maybe inclusion with central bank, I don't know, where it stayed in a 50-year range. You go back and look at copper or lead. We ran those charts a few weeks ago, you go back to the 1970s, and you'll see that they were in a range, 1970s, 80s, 90s, into mid-2000, like 2005 or 6.
Turning to metals, the silver market remains structurally peculiar. Mine production rose only modestly in 2024, 0.9% despite booming industrial demand. Meanwhile, deficits have stacked up. Since 2021, the shortage amounts to hundreds of millions of ounces. With silver heavily embedded in solar, EVs, and electronics, and yet largely produced as a byproduct of other metal mining, a major supply response is unlikely. That sets a stage for a potential breakout beyond the previous range.
Where they were stuck in this orderly reality, up, down, up, down, up, down. And when they came out of it, literally in a few quarters, they quadrupled in price. These were different times. They weren't doing it together. Copper went up in like 2005, 6. Lead went up in 2007, so it wasn't the same driving force. But they quadrupled in price. And then since then, they've lived in a new zone of reality that's like 4 times the average price of that prior zone of reality. How come silver's still in the prior zone of reality? Look at gold. I mean, where was it in 1980? $850. Silver was 50. Okay, where was it in 2011? 1920. Where was silver? 50. Gold's 4,000. Where's silver now? 48? Okay, what's going on here? We know silver's in great demand by high technology. Solar panel production, Chinese are about 80% of that market. They need silver in the cells. And there's also AI demand for silver. Microscopic but pervasive, okay? It's a great conductor. And we know for 5 years now, the new supply has not met demand. There's been a deficit 5 years in a row, supply-demand deficit. And we know that when silver price goes up, it doesn't induce necessarily more silver production. Why? Because most of silver production doesn't come from silver mines. It comes from base metal miners who are primarily motivated and focused on getting copper out of the ground or magnesium or whatever. And silver is just marginal to them. Therefore, if silver price doubles, it's not really that much of an incentive for them to produce more. If silver matched lead and copper, it could go to $200. Okay. Now, and also if you go back and look at 1980 high at 50 or 2011 at 50, and factor in the decay in the money in it, the buying power, the real buying power, the dollar, not the dollar index, that's measuring paper versus paper.
Historically, silver peaked around $50 in 1980 and again in 2011, but those levels don't account for diminished purchasing power of the dollar. In real terms, silver would need to trade far above $50 just to match those highs. Given today's structural deficits and industrial tailwinds, the argument grows for a surge toward new valuations, some forecasts pointing well above $100 per ounce. It's not a maybe one-day story. The convergence of monetary impulses, tech demand, and constrained supply could mean the next silver phase plays out faster than many expect.
But the dollar quantity almost doubles every decade. 90% increase in the quantity of M2, Well, if you factored that in, silver would probably be $200 now just to match those highs in real dollar terms. Wouldn't be exceeding them, it'd only be matching them in real dollar terms. So all kinds of things point to the acceleration phase going dynamic into a new reality. And the problem with getting over 50 recently is we surged from a low under 30 in April. Okay, started to come back up in May, and in June got back up to 34 plus, had two prior highs at 35, May last year, March of this year. So in June of this year, came back up to 34, headed toward those highs, and momentum said you're going to break out and you're going to explode. It's significantly different than what you've been doing instead of incremental. Well, sure enough, you went from, $35 to 53 in a handful of months? I think it deserves a correction. Plus, when you took out the 50 high, what happened? Every idiot investor out there who thought the two highs at 50 were meaningful. Again, nominally they are, but in real terms they're meaningless, real dollar terms. They got sucked in to buy it finally. And so you had latecomers come in at 52, 53, and they bagged them. Good. Should have been bagged. They should have been buying silver in the 30s or the 40s or the 20s even. And when they bought high, it created a vulnerable group of people. And so that's a logical place to have finally a correction that you could call a correction. You break that spread out, silver versus gold, and add to the gold stock market spread breakouts, which have already occurred, just waiting on the S&P now for that factor, the game's just beginning. And that's when you see a total change in what you expect and in tonal nature of the markets. Something more like what occurred 79 to 80.
What ties all this together? The interplay of assets, Bitcoin's potential breakdown, tech stock market flow relationships, and metals gaining momentum as capital seeks refuge in structural value. Money doesn't vanish, it migrates. If the stock crypto complex falters, it could shuffle toward metals and industrial commodities. We're watching key levels, Bitcoin's support, silver's breakout zones, major equity support floors. Whether you're a macro investor, crypto strategist, or metals enthusiast, this confluence of dynamics matters. The game isn't about isolated assets, it's about where capital goes when the music stops. Stay tuned and be ready.
And by the way, when we get there to those levels, sure, you get a sharp correction maybe, but you're in a new reality. You're not going 150, 200 and come back to 50, okay? You're going to live in a new reality up there. Maybe it's between 150 and 250, I don't know, but the main focus right now is that surge, because it should be very dynamic and a place to be you've probably not been in your entire investment lifetime. So game is on, but we're watching those two metrics, gold S&P, silver gold. Well, we look at all four major asset categories in our all asset subscription, bond markets, foreign exchange, commodities broadly, but especially silver and gold, and the stock markets, not just ours, but elsewhere as well. Because you got to look at these things because they're all banging into each other. Like if the stock market breaks, as we argue it's in process of doing, that money goes somewhere. Well, silver and gold are pretty small markets compared to the stock market. And especially the miners are a tiny little market. You move much money from the stock, but look what's happened to GDX recently. Would you go from 40, 50 up to 80, $80? Bam, like that. That's a new reality. And therefore, the action of these other categories is very important to further fuel the monetary metals.